Good morning. It is Friday, May 8th, 2020, and we are a week removed from our big investing after coronavirus COVID-19 presentation with the report that I put out. I thought seems like a lot of people are finding to be useful. So if you haven't taken a look at this, I urge you to take a look at it. It's 67 pages. It has links to charts, which you're going to need to use the very short list because I'm, going through the charts constantly, updating them. But this is a good way to get started. And I thought today that what we'd like to talk about is our investment process, because I think that we have put that aside. And there is a lot of FOMO out there in the market right now, and I'm going to show you some reasons why that is very misplaced. We'll do that by going through our process. Ultimately, we're going to end up talking about technical trading and things like that at the end. And I will preface it right now by saying, look, there is no magical, always right technical trading out there. It doesn't exist. In 25 years, I've tried them all. I've tried Elliott wave theory. I have tried point and figure. I have gone through, from stochastics to Bollingers to, dojis to, you name it. If it's out there, I've played with it. And what I can tell you is that the thing that I come back to over and over and over again is money flow. Very simple economics, and we'll talk about that in a moment, but supply and demand. Supply and demand is what moves every market in the world. So if you can have a good view on what supply and demand is, then you can figure out what the price is and should be. So we will get to that soon. And I will say that one of the things that I've been using more and more that is actually newer to me, only probably a year ago I started playing with these. I really like Fibonacci levels. You heard me mention the word confluence last week, and I always just refer to it as market structure. But the Fibonacci levels really open your eyes to the fact that things happen in patterns over and over and over again. So we'll go through that. In any case, our investment process. What do we have? We have a 4-step investing process. We want to understand and follow the long-term secular trends, analyze the impact of government and central bank policy, do fundamental analysis of industries and companies, and then do price trend analysis using technical and quantitative indicators. This process is an original approach that I stole from somebody else. In fact, some of the top hedge funds and money managers in the world go through this process, and they seem to have done very, very well. I don't even remember the names of the 2 or 3 firms that I found doing this years and years ago anymore, but they were big funds that were killing the market. So one of the questions I get is, I talk about the economy all the time, but why isn't analyzing the economy in here? Well, I would answer that it is. The economy is ubiquitous. It is everywhere. So in every one of these, we're talking about the economy. Long-term secular trends, economy. Impact of the government and central banks is on the economy. The economy affects the fundamentals of industries and companies. And technical analysis and quantitative indicators are really just measures of the economy and the psychology of the economy. So what do we know about secular trends right now? Just to go through a quick review. 5G, IoT, AI, perfect marriage, right? That's what the executives at CES, Consumer Electronics Show that I went to in January, two of them said exact same thing, different forum panels, perfect marriage, right? You have low latency, reliable communication, machine to machine, and now the machines think. Augmented reality and virtual reality, just overwhelming applications from anywhere from entertainment to industry. And I've talked about the applications in industry, and some of our companies, one of our favorite companies, is into augmented reality and the whole IoT for industry. Fintech, biotech, and then alternative energy, smart storage, and smart grid. And there's more subsets in here, but really from here down, this is where we're going to find the biggest trends in the economy over the next decade. Now, coronavirus, COVID-19, shocked the system. One of our deals as investors is that we often look for short-term profits based on long-term trends. And people often get disappointed because what they can see coming doesn't reflect themselves in stock market gains or investment gains quick enough, or just changes in general. And one of the old sayings, I think this is a Bill Gates thing, I'm sure he borrowed it from somebody else, is people look at the next 2 years for things to happen when really they should be looking at the next 10. I think coronavirus, COVID-19, shocked the system to flip that upside down. What we thought was going to happen in the next 10 years, the things that I talked about in January and February as what we should be paying attention to for the next decade, are going to happen in the next 2 years. The shift to the work from home economy is happening right now. And what we are finding out from surveys of employers is that they believe that they can work with fewer people now because the productivity did not go down by having people being less supervised and working from home. There are automated systems now that can tell if you are engaging in some sort of activity in the computer network that you are a part of. And they can just tell by the metrics at the end, hey, did you get your job done? So this whole work from home economy, the fact that we had to start using technology, crash course in technology, from business to industry to education and to medical fields, is pretty amazing, because I don't think it would have happened this year or next year or even in the next 3 or 4 or 5 years. It would have trickled in over a very long period of time. And now we've been basically told, hey, jump. That's what we're doing. We're jumping. Right now, government and central bank policies are pretty in our face. There is massive support for the bond markets. And I think that there is a huge misconception about where Federal Reserve money is going. It is not going into the stock market, and I'll show you that soon. Federal Reserve money is going pretty much 100% into the bond markets because if those bond markets fall apart, and remember, the bond markets are many times bigger than the stock markets, right? The debt market drives the economy. But bonds are tied to all sorts of derivative instruments, CDOs, collateralized debt obligations. I've talked about these in the past, and if a counterparty goes bad, especially a big one, that can ripple through the entire system, setting off a domino effect, just like in 2008. That's what happened. We had counterparties that went bad. We were lucky. We were actually lucky in 2008 because AIG underwrote the the insurance on almost all of those bad debts. So as the debts went bad in 2008, The insurance on those debts was held by AIG. Well, AIG couldn't possibly pay off all those claims. But because it was all in a centralized location, the government bailed out AIG because that ended up having the reverse domino effect of bailing everybody else out. This time around, there is no AIG. There is no one firm that underwrites the risks for almost everything. So, whereas the credit default swaps were backed by AIG years ago, the credit default swaps are all over the place now. And I would say that one of the drawbacks of the regulations is that there isn't a central clearinghouse anymore. And that's really what AIG served as. All the credit default swaps essentially were tied to them somehow. And not all of them, but a lot of them. If the system goes down now, that is a spider web sort of mess. How do you bail that out? Well, the answer is you pre-bail it out. You don't wait for the collapse. You just start having the Federal Reserve buy all sorts of debt. And that's what they've done. By most measures, the Federal Reserve is going to get to the point where they own a third or half of all sorts of different debt obligations. That's massive. How can the central bank of the country be the main holder of debt? At some point, that's a problem. I don't know how fast, but it's something that's going to require a bailout. And it's going to be a big bailout. It's going to be $10 trillion-ish by the time all is said and done, maybe more. The government is responding with fiscal policy that is supposed to be helping Main Street Americans and small and medium-sized businesses. And for the most part, it's been fairly successful. You see the headline stories of bigger companies that have access to the credit and equity markets borrowing money, and they shouldn't be, but they are. They should be issuing stock or taking debt because they can. And it's not anybody's business but theirs, and nobody's fault but theirs, that they didn't have the safety nets that they needed for an economic shock. And to claim that they shouldn't have been planning for something, maybe not as severe as coronavirus, but they shouldn't have been planning for a deep recession, is just, if you don't believe they should be planning that way, then you're not a capitalist. Because a capitalist always has to understand that there's economic cycles. So if you're not planning for a rainy day, don't cry when you get wet. And that's what's going on with a lot of companies. It's why stock buybacks are on the ventilator themselves right now. So what the government is doing right now is not enough to keep the economy strong, but it's enough to keep people from being hungry and losing their homes, presuming the money gets to people. And that's been a bit of a problem. The unemployment systems across the country are all backed up. I know people in Wisconsin who filed 3 weeks ago, and they haven't got their determinations or first checks yet. I mean, the fact that we have a state-by-state unemployment system is probably one of the dumbest things that we have going in America. We can have state-by-state offices for services, but the fact that we don't have a federal unemployment system is just one of the most amazingly dumb things that we do, because we throw out this idea that states are essentially sovereign little countries, and they're not. So when we have an economic shock, we go through all this crap with old computer systems and little fiefdoms, and the claims don't get processed. So, keep that in mind when the next administration, whether it's this one or a new one, comes in, is that if they don't address the unemployment system, then it's just going to keep being a problem. And maybe at some point we fix these problems. And that's what we should keep an eye on with the government, because they have to find a way to do that, Because if this system was working better, the economy would be better. So that's simple. If the unemployment system was working better, the economy would be working better. One of the things that we have to keep on is that the debt is piling up in this country. I don't even know what it is. Probably, what, $24, $25 trillion at this point? At some point, we probably ought to worry about that too. It is one of the reasons that I have gone from being a gold bear for the better part of 7 years to, in the last year or so, being a gold bull or a gold bug. Does gold bug mean you're permanently bullish on gold? And then I'm not that. But I am bullish on gold for a while, for a few years probably. So what are the fundamentals? They are deteriorating at a rapid pace. So if you are new to this webinar, take a look at the last webinar. I went through a lot of charts. I don't want to have to go through everything every single week. So go through the history and spend a little time. But we got the worst print in history today for unemployment in history. The estimates are that between 1/3 and 1/2 of small businesses are going to fail by the end of the year. Estimates suggest that around 40% of job losses will become long-term. And in the autumn, when the payroll protection program starts handing out their loan forgiveness, right after that, you're going to see another wave of unemployed. Why? Because these companies are going to suffer from lack of demand, so they'll need fewer employees. And these people will end up on the unemployment system as well. What did we talk about last year? Unemployment drives the stock market. If a lot of people are unemployed, the stock market generally falls apart. We've seen that over and over and over again in history. Every recession has been met with a really bad stock market. And the correlation is that people aren't putting money into their 401k plans. And if you are long-term unemployed, which is what this is going to end up being, you start cashing in your retirement plan. Or you take money out or you cash it in. I don't expect the retirement plan cash outs to come for another month or two. And they'll really come hard after that as we get towards the end of the year. So pretty much I believe that the rest of this year is going to be challenged on cash flow because retirement plans, that's a form of forced selling if people cash those in. So what does the price trend analysis say? Well, pick your favorite technical indicators. I like relative strength index, money flow index, shaken money flow, MACD, some oscillators, and what I don't have on here is institutional bias. And when the institutions are negative, you probably ought to be real careful if the stock market's still going up. Ultimately, every form of technical analysis is a measure of group psychology. And while group psychology can be really good and support markets for a while, I will tell you there is an equation that never fails. Never fails. So the perceptions that people have about all the stimulus on the markets, what they think about medical miracles coming, what they think about maybe if there's never a medical miracle, which we got bad news on this week, and what happens as companies continue to go bankrupt, all those things will affect group psychology. What we should really keep an eye on, though, is a very simple equation. If you took the economics 101, then you know a very simple thing. Supply and demand determine price. So if the supply of stocks is increasing, then that means the price will fall. We know that the supply of stocks has been decreasing in recent years, driving the stock market up. corporate buybacks have been enough to not only create demand, but to reduce the number of stocks. So while buybacks push the red curve out to the right, the supply to the left, pushing the price up. So what happens when that changes? Demand and supply are going to change. Supply will go up, or at least hold steady, and demand will fall. So what do we know about stock supply the past few years, right? The stock buybacks reduced the shares in the stock market dramatically. According to Goldman Sachs and some other firms, buybacks are going to fall by about 50% this year. I think the number's higher. But more importantly, the number of companies doing buybacks will fall, and most of the buybacks will be concentrated in about 40 companies, maybe less. The big bulk of buybacks are going to be like 8 or 10 companies. So if all these companies that were buying back 2, 3, 4, 5% of their shares every year no longer are doing that, this is something that I track over on StockRover. What does that mean for their share prices? Many of these companies are in the S&P 500. Many of them are in debt, and some of them are already talking about cutting their dividends. So once they've cut their buybacks and cut their dividends, where does their price go? What does that do to investor psychology? This is a great chart from Wells Fargo. Buybacks were more than the fund inflows from mutual funds and exchange traded funds. And in fact, last year, outflows from the market exceeded inflows from retail investors. It was something like $48 billion came out of the stock market last year. But the buybacks were so big at a record, just coming off a record. When this orange line falls all the way down to around here, that's what it looks like. And retail investors invest less. Oops. And mutual funds are constantly in outflow, right? Everybody's switching from mutual funds to ETFs. That's really what that is. Pretty mirror image, right? But in 2018, there were outflows. 2019 outflows. You know, there's not a lot of retail money going into the market in most years. And I believe it's 4 out of the last 5 years, more money's come out than gone in. And the only offset has been the corporate buybacks, which are going away. So there was an article on Market Watch, and they talked about how money flow into and out of the market only affects the market for a couple of weeks. And there's some truth to that, because that's always been the marginal money, right? So the last 5 years, the buybacks have been the big money. Retail's just been the marginal money. But again, what happens when the buybacks are gone or dramatically reduced? I told you a year ago that we'd wake up one day and the market would be limit down. And we saw that, 3 times in March? And it's because the market structure is built upon a fallacy, which is that buybacks are normal and forever. They're not. They never have been. It's just been a bubble. And I talked about that in an article 2 years ago. I said the buyback bubble will end badly. And right now, we are on the cusp of the buyback bubble ending badly. If you haven't read that article, I would suggest that you read it. About 2 years ago on the nut. And I go through the abnormality of buybacks at the levels that they've been and what that's going to eventually mean. And I cover a lot of topics. One of the things that I've learned, and the chief financial officer of a billion-dollar firm said this to me, along with my father, is that I tend to be early on things. So I have adopted more of a technical trading approach. I can see what's coming, just like a lot of people. But how you trade it is, what makes you the money. And so I believe that this buyback bubble is ending right now, coinciding with retail not having money to invest. That's going to end up having a pretty dramatic impact on the stock market, I think, really soon. So when you go through this, all you keep coming away with is there's going to be less people buying stocks, fewer companies buying stocks, and potentially more stocks on the market because these companies are going to have to recapitalize. So we take a look at the fund flows, and what we see is that there was a retail rally. And you can see the headlines in the papers. The retail market was a buyer in April. All these people on Robinhood, and again, remember, this is the end of the retirement money going into the system, right? Every March and April, really, the January effect is the bonuses, and then February, March, and April is people putting their hunks of money into IRAs and getting their matching dollars on 401ks and things like that. So this would mark the normal end of 401k matches and IRA contributions. Although those have been extended, I don't think that has much impact. So you had people who traded the bottom of the market, right? There's a lot of traders out there pushing money around, and they played that technical bottom. And now, from 8 billion of inflows down to 5 billion of inflows, down to 2 billion of inflows, down to negative 7 billion last week, about negative 15 billion this week. Just like money flow index, this is a leading indicator. In the next 2 weeks, you probably see this market lighten up unless there's a new source of money. So when we take a look at money flow, this is a chart of this, and it's lagging by about a month because the data is not free. You can see that as money flow falls, you get choppiness, then a correction. That was 2018. We're going to show this chart another way soon. Then money flow was all right? It's positive. Stock market goes up. Money flow falls off a cliff here in March. Mainly institutional investors, and the stock market falls apart. So it got all the way down here, then it rallied, and now it's starting to fall again. And here is what happened today. Can you, in any logical way, tell me that A, this is not going to impact consumer demand, investment dollars going into the market? Does anybody believe that there's going to be a V-shaped recovery? Coronavirus deaths are on the rise again. We have not bent the curve. I actually just put this chart up somewhere. In fact, I probably haven't. And I will try to show it to you if I can find it quickly. This is coronavirus deaths in America through 2 days ago. We've had some drops, and then it keeps coming roaring back. And what we need to see is this curve, or not this curve, but this stack, right? we're at 2,500 deaths a day right now, just about. And the worry is that we're going to get up to 3,000 deaths a day. So if this chart goes like this, how does that inspire confidence in the markets? Yeah. So I'm not going to comment on, people are asking me about some other analysts. I will just say that the guy that was mentioned is an idiot. I've known him since Market Watch. He's just a trend follower. He doesn't know shit from shine. If you're going to ask a technical trader about the economy, you're making a mistake. Ask a technical trader about technicals, right? I mean, because they live and breathe that stuff. And they don't even care about the fundamentals or the narratives unless it supports what their trade is. So they backfit everything. My trade worked, therefore my story is correct. My trade didn't work, my story is still correct, and my next trade will work. That's how it works. That's the way it is. So what we really would like to see is this daily deaths get, way down into the hundreds. Because we thought this was a bad deal when it happened. But now look where we are. How do you get a V-shaped recovery? How? Are you all running out to the restaurant right now? Are you all running out to the theater? Are you all going to go jump on an airplane? On a cruise? Are you going to hunker down a little bit? Make sure that you have money in case this lasts longer. So I would just say, I think it is probably very naive to think that things will rebound quickly, especially with this picture, the unemployment picture. So when you do your investing, have a process, streamline things, and understand what underlies the technicals and the quantitative data, but respect the technicals and the quantitative data, especially in the short term. In the long term, fundamentals win, right? In the short term, the stock market's a beauty contest, and in the long term, it's a weighing machine. So, if you're going to screen for stocks, I've told you that I like Stock Rover because it allows me to sort things any old way that I want to. And then figure out how to chart things. Not because it's going to give you a magical answer, but because it's going to give you perspective. So let's take a look at the S&P 500. When I put in my trend lines, I don't just like willy-nilly it for real. I mean, I eyeball it, and then I go and test some things. So what we can see is, I want to move this down. I wanted to get rid of the color here to make it a little easier, so I'm going to have a new format. As we can see that institutional bias has been negative for a while, since the early in March, and institutions still aren't investing. That's a big deal. For the stock market to rally, the institutions are going to have to buy, and they're not giving any signal that they're ready to do that. Relative strength index, and this is a weekly chart, is in the middle. What have we said about the middle of the market? Try to avoid it. It's hard to trade this. So if this goes up here, you can sell in mass. If this goes down here, you can probably buy again. So this was probably a good spot to buy. I think in hindsight, clearly it was. We should have known that going in. But who knew that this wasn't going to go down to here, and that wasn't another 20%. Still, we bought a ton of gold, and that went up 50, 60% before we started trimming. So, you know, that's good. So when I take a chart like this, and this is weekly, this is not daily, this is not short term. I just grab some Fibonacci lines, not because they're magical, because it gives me perspective. All right. So it puts in a bunch of levels, Fibonacci levels, where things tend to gravitate towards. Notice this one. So from way back here, back in 2009 to the top, look how perfect that was. It hit right at a Fibonacci level. And things like that happen over and over again. What this tells me is that this was the end of the bull market. That was the true end of the bull market, the secular bull market. If we test the trend, get here to the bottom. Where'd it go? Right there. It puts in another set of lines. And what we see is that there's some levels in here where you start to see some confluence. And there's only two sets of lines, so we don't know where the confluence is yet. But right here is that battle zone that we've been in, right? We've been fighting this. But we're a little above it right now. So that should tell you either we're breaking through or this battle zone's a little bigger than we thought. So what can we do? Grab another set of Fibonacci's and start from the set of this super long trend, right? A primary count if you're an Elliott wave person. Go to the shorter term trend, which is the last local low, back up to the high. And now you start to see, oh, look, there's some confluence there too. And then, again, take your trend tool, back up to the high, back down to the low, shorter term time frame. And you start to see where some of the overlap is. We've gotten through these levels. And then here is where you start to go, oh, look, just above 300 on the S&P 500, that might be the top of where this pivots back around. I actually think that's probably true. I think we're coming up on a top. So I want to make sure my lines are about right. And I want to go to about here. About where I think it, you know, and then I go right where the options expire. So May 15th. So I think this market can run another several points, 4, 5, 6%, whatever that is. Although you have to respect that it's chopping around in here. It just looks like it's going to break out though, right? Doesn't mean it will. It's just flirting with this fib level, right? About 292. Went through it the one time, came right back down. So we'll see. We'll see. Why are these lines important but not magical? Because so many goddamn people look at them. And Fibonacci numbers are naturally recurring in nature for whatever reason. From the symmetry of the sizes of bones in your body to just, I mean, you can Google Fibonacci ratios in nature, and you just find them over and over and over again. We have no idea why. The math is beyond our comprehension. But the reality is it just happens over and over again. So when we take a look at I switch from weekly to daily chart. We want to take a look at this. Let's see, get back to my weekly chart. Where can this go? And this line right here, if you respect market structure, this red line seems to respect that market structure. And that Fibonacci level, maybe it's important, maybe it's not. It's all by itself. But this one down here, right? This is the overlap of several lines. So I think that this whole 160-ish level on the S&P 500, I think that's probably as bad as it can get. Oh, I see what happened. I grabbed something. There we go. I broke my chart, didn't I? Okay. Make sure your dots are closed. There we go. Oh, why am I doing that? What am I grabbing onto? It was all set up. Well, we could always do it again. But right down at this 160-ish level on the S&P is probably, oh, here it is, right around here. It's probably as bad as it can get. So when you try to figure out where this is going to, that's probably as bad as it can get. 160, 170, 180. I have a hard time in my head believing that we can go all the way down to these huge support levels going back to 2009 and 10 and 12, 2010 to 2012. I mean, we really have to erase a lot of history, right? To go down here. I have a hard time believing it can happen. Doesn't mean it can't. But given that we know that the money flow is not good for the stock market unless something turns institutions around, right? Unless institutions start to believe that these prices are a bargain, which they didn't, even before coronavirus, right? You had your retirement, inflows, and then last year was good, and then they turned red, pretty quick when they heard of coronavirus. But they were red back here too, 2008. So they're very shock driven. If unemployment stays bad, they're not going to turn bullish. And I would point you all the way back to 2008 and 9. Look how long the institution stayed bearish. It's a pretty long time. This is pretty quick. I have a hard time believing that the institutions are going to flip real quick. I could be wrong. They could. Maybe they will. But as we get over here into today land, right, we start looking at things. This 300-ish area on the SPY, I think that'll probably be your last chance to do a lot of selling. And I don't know that I'd be trying to be too perfect. If your risk tolerance is that you can't stand a giant loss again, I would really go through your portfolio and get rid of the junk and your lowest conviction stuff and any company that you think might have a problem with their dividend. Because I know a lot of people chase the dividends. And those are all on the chopping block. Do you really want to be invested in a company that has to raise debt to pay their dividend if supply and demand doesn't, resolve itself in a more positive fashion? So my only suggestion is don't fall for the hype that we're going to get a V-shaped recovery. If we do, plenty of time to jump on later. But the odds are highly against it. So this level right here, there's a lot of confluence, and I'd be careful of it. Right around here is where I think I'm going to start buying more puts on the stock market. So I think that by next week, Thursday or so, I'll be buying puts on the stock market. Maybe Wednesday, somewhere in there. Sometime middle of next week, I'm going to look to buy puts on the stock market that are probably a little bit longer in duration, that flow into the whole unemployment wave that's going to come after PPP is done. And again, don't believe that everybody's going to keep their job. If you think that, you need to recycle what you're thinking, because the employers are already telling us, right? If the employers tell you they're going to fire people, they're going to fire people. Just like the car companies, if they tell you they're going to make EVs starting to be their main things in 2025, that's going to be their main thing, especially when there's a law that tells them they have to. So control your FOMO. I think that right now is a great time to sell long duration calls again. So if you can sell long-term calls, sell long-term covered calls on things that you like, that you want to hold long-term because you're collecting a dividend and the dividend is secure, add some extra income. Write a covered call out into the autumn, October, November, whatever is available. Could even go to January. But write a long duration covered call, capture all of that time value, right? Capture all of that time value, and that'll help you smooth out the volatility that's coming. Now, I don't want for the stock market to go all the way down here or here. But I think we have to accept that the risks are so high right now, and the money behind this rally is so thin, and the buybacks are going away, and unemployment's going up, and 401k plans are going to get cashed in, then unless there's a magical Federal Reserve solution, this is just the typical bull market rally, bear market rally. That's all that is. So we're splitting hairs trying to pick out where it's going to end. We know it's much closer to the end than the beginning. Now, there is something, and I'm going to show you this, because I think it's important. Let's start over with this chart. Oh, I knew there was something funky. We'll go all the way back to, I'm going to pick a specific date. Get rid of all these. Who cares? We'll go back to that bar right there. No, not that one. This one. Go to the weekly chart. Just want to show you something. Weekly chart, excuse me. We're going to go back. Right here. That little bottom here, this little box right here during 2016 where the stock market just moved sideways for a year, right? So let's take the last. that point right there. Oh, no, not that one, because it broke out. What was I playing with? Right there, that correction right there. What is that correction? What happened in November of 2016? That was the Trump bull market starting, right? After this period leveled off, started to look like it was going to turn over. We got tax breaks, deficit spending, pushed the stock market way up, right? But the Federal Reserve a couple times tried to normalize, and the stock market hated that. So you take a look at this and you go, huh. Remember, this line up here was the top from the Fibonacci's that went all the way back to the bottom in 2009. Right? So that's what that represents. That was a perfect Fibonacci retracement I showed you earlier from the 2009 lows. So this is probably the top of the old bull market. And for us to break through that, it's going to have to be a new bull market probably. And we don't know, right, until it happens. But let's take a look at these fib retracements. If we go start here again, go to there, which is the top, go down to the bottom. You start to wonder, is this the bull market we should be thinking about? Rather than the bull market off the 2009 bottom, should we be starting about the bull market that started with the last presidency? If this breaks down below here, right? I mean, we basically had erased all the bull market gains under Trump for a day, right? Or almost 99%. Is this market trying to tell us something else? I don't know what the answer is. I just think it's interesting that it got back down to this point. And really, that was the next week. That's when it started. So the fact that we got to within an inch of erasing the Trump bull market makes you think, something else is going on here. That maybe we have to reconsider the time frames that we're measuring when we do the technical analysis. What's more important, the rebound off of 2009 or the bull market since 2016? What really is the psychology at play here? I think an argument, and I'm not saying it's right, I'm just saying I think an argument can be made that there is what I talked about last year, right? I've told you that Trump's probably going to lose, even before coronavirus, because I see the data sets from the private polling people, or I'm told about them. They don't show them to me, but I believe the people I talk to. Could the market, and remember, Larry Fink from BlackRock just talked about this, could the market be fearing a Biden presidency? I don't think it should, because in the long run, it's the long run. But in general, I think that there's a fear starting to happen that I told you would happen. And that might explain why the institutions are still bearish. They didn't participate in the rally. And the wealthy, the family offices, still haven't reinvested any money. So we know that the family offices, the richest people, haven't invested, and we know that the institutions haven't invested, and we know that the outflows have started again. So I just think that maybe we're thinking about things out of context sometimes. Maybe, I finally got my circles right. Maybe this market is afraid, not only of coronavirus, but of a less favorable stock market administration. And remember, you've got a shift left in part of the Democratic Party, not the part that's winning anything, right? The middle of the party keeps winning, right? That's who got all the congressional seats. It's not the far lefties that are winning anything, but they're loud and they have a voice. Just like on the right, the extremists are loud and have a voice. What if there's restrictions put on buybacks in the future? What if corporations are told you have to be net debt-free before you buy back shares? What if they put a restriction on dividends? I don't think that would happen. But what if Elizabeth Warren and some of the other people say, look, these buybacks should not have happened the last 5 years, and I actually would agree with most of that. These buybacks left companies too vulnerable. What if there's a rule that says you have to be net debt-free before you buy back shares? What would that do to the stock market? It would be a major reset, right? It would basically mean that the baseline we should be thinking about is in fact down here. That maybe this, down where we were, should be the baseline. Because this were all the gigantic buyback years. Just keep that in mind. Like I said, I'm not real complete on my thinking on this yet, but I have said that I think that the market's going to fear, again, I don't know if it's for good reason, fear the Democratic administration. And if the buybacks get some minor rules, right, the banking industry, in the financial industry will go mental over this. But I don't know. Is it a bad rule that you shouldn't be able to buy back shares unless you're net debt free? I don't think it's a bad rule. That means that these companies would be able to withstand recessions better and any shock, things like that. So I don't know. I don't know what rules are coming, but I just think that when Larry Fink from BlackRock gives a speech and he says, be careful, the Democrats are coming, which is basically what he said, it just tells me there's more things at play here. That this buyback, right, the Trump-fueled buyback boom might be going bye-bye. All right, I just want to look at one other thing for you, and that is the gold miners. So we did really well to buy the gold miners at the bottom, right? I mean, that was our main buy, was this right here. So when you take a look at all these things, you start to get all sorts of weird Fibonacci levels because this is such a long-term chart. So that's the first line. So that's where my yellow line is. That's the market structure. It looks very much like we've broken out, right? So that yellow line, I think, is something that you can buy or sell puts from. Because the market structure, not only is it a fib level from the trend that was reestablished right after the big crash in gold. I use my scroll wheel on my, okay. So this yellow line is where I think you can probably buy here, okay? I find it incredibly difficult to believe that GDX gets under 20 again. But if it did, you should back up the truck. But I really think we can look at some of these other levels. So you go here. I used the wrong line. There we go. So we don't even know. There you go. Right there. Yeah. Really should have been over here. So you start looking for confluences, and then you can use your daily chart to do it over here. And what you find is what I was saying weeks ago. I usually erase all this stuff because it just gets cluttered. But right in here, that's I think where the red line is. So if you can get GDX around 27, I think you're doing yourself a favor. I mean, we'd have to have the mother of margin calls to get back down here again. So if you do see the market start to crash here, then maybe you hold off when it gets to here, and you have to measure, right? At that point, you have to measure, because it could, you know, this is right here, this level here at about $19, super heavy support, right? It held right there, went through a little bit, but came right back, went through because of the margin calls and came right back. I mean, take a look at just how sharp this rally was. I mean, this is just margin calls. And then bam, 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 bam. And now it's breaking through. So in the absence of a really bad market event, this 31 area probably holds. If there's a correction, probably gets to the mid-20s. And if there's another horror show, you know, maybe you get it down at 1920. But I do like the idea, if you're not too overweighted in GDX, or if you've already written covered calls, think about how you might get more exposure to this by selling puts or buying on the corrections. But in my case, I'm about 15% in GDX, but I've written covered calls across most of it. Capped my return at around 60%, 63 or something. So anytime it comes back to about here, I would be inclined to sell cash secured puts, like $27 cash secured puts. Probably get $2-3 for it. And, you know, the only time I wouldn't do that is if I really thought the shit was going to hit the fan. And I'm inclined to believe that it probably will, but I'm just giving you options, you know, things to think about. Because if we just get a normal pullback and really the people calling for a V recovery end up being right, you know, then you're going to want to get that exposure, right? But again, measure it against your risk tolerance. You're not trying to be Nostradamus. You're trying to make a series of good decisions that end up working out well in the long term. I would probably sell covered puts if we get to the yellow line with strike prices at the red line. That's what I would do. Again, unless it looks like the world is ending for a little while. And then I try to get greedy and I look for, right? I look for oversold. I don't know that we get that. But that was the oversold. I mean, look how sharp these moves are. And that's something I've been talking about for a couple of years, since this market was going to get this way. And ultimately, my opinion is that we're going to get the reset. I think this market gets all the way down here. I think we set new lows. I don't know that we go much below that. Right? I don't know if we get all the way down to this 182, which is pretty significant support. You look how many times it didn't go through there. So I think this 182-ish, 183-ish is pretty huge support. I'd be shocked if we really get below that. I really would. We'd really have to have a lot of bad news and bad things happening. The other thing I wanted to show you, I'm going to get rid of this real quick just to unclutter it, is remember, we kind of had a bear market already during the Trump administration. Take a look at from here. Did it not let me draw? There we go. Oh, there it is. I just want an arrow, guys. Here. Oh, I don't know why it's doing that. Oh, whatever. So from here to right about there, we went through a period from January of 2018 to June of 2019, where the market didn't make any money. Then we've got the huge rally here. Immediately fell back to there and then fell through it to basically the 2018 lows. So I don't know. I mean, a lot of these things are repeating themselves. And now we're fighting right around this area again. I just keep looking at this level here. Right around 200 on the S&P, I think, is pretty likely. I really do. I really think that's pretty likely. I think we probably see a 30% correction from here. So it's not a guarantee. There's no guarantees. But given the underlying market structure of the thinness, coupled with the buybacks, coupled with the unemployment, coupled with the bankruptcies, it's hard to see us not setting a new low. Somewhere between whatever that price is right there, 210 on the S&P down to about 182. Somewhere between 210 and 182 just makes a ton of sense to me. So take that for what it's worth. It doesn't look healthy right there. And when you take this to the daily chart, right, you stretch it out a little bit. There's a heck of a rally off the bottom, but it hasn't done much in a few weeks. Just kind of chopping around. If it breaks out, then you should all thank the Federal Reserve because they figured something out. But like I said, most of that money is going into bonds. It's not going to the primary dealers like it did before, right? That's the mistake that people make on the Federal Reserve money. The Federal Reserve money went to the primary dealers last time. This time it's just going into the bond market. Just straight buying bonds to make sure the companies don't go bankrupt, which they're not going to be able to stop in a lot of cases anyway. So they're just trying to protect the investment grade and borderline investment grade companies. The companies that are junk debt, they're in big trouble, and they employ a lot of people. So I hate to keep being the bearer of bad news. The good news is I think we're going to have a roaring 20s. I do. I think that 2-3 years from now, things are going so well that people are shocked. I think there'll be new homes being built. I think technology is going to show us a whole new thing. I think a lot of things come back. And a lot of this is predicated on my belief that the biotech sector is that good. I think the biotech folks are so smart that they will figure out coronavirus. Even though we have learned that it does mutate. And like I said earlier, probably there's not going to be a lifetime immunization to it. It's going to be something you have to take every year because it's like the flu, it changes, is what we're learning. So, all right, have a good weekend. If you go out in public, wear a mask. And if you're hanging out with people who are at risk, be very, very conscientious of that. And try to protect yourself because that protects other people. All right, have a great weekend. I'll answer a couple questions off here.